You're watching Personal Finance with Coach Kelvin. Let's get into the video. Hey guys, Coach Kelvin here. And today I want to talk to you about whether you should possibly pay off your mortgage first or you should invest in shares. Because you can obviously do both, but what's going to be the best return on time and investment when you're trying to increase your net worth, okay? So when you obviously own a property, you have a liability, which is your interest rate. And whatever amount you have loaned from the bank, you're going to pay an interest rate on that as you return those funds to the bank over the course of that mortgage. Here in Australia, most mortgage terms are 30 years, and you will generally, at today's rate, get an interest rate of around 2.5% or less. Obviously, you can get better rates if you have a really good credit score. You're able to put down a big deposit, and there's other factors involved. But let's just be very simple and keep it at 2.5% or 2.49, which is my current one, just as a very easy to figure out number for today's sort of video. So when we look at the compound returns of the stock market over a long period of time, we can assume around about 8% returns over an extended period. Obviously, we've seen an inflated number or a version of that from last year to now because we have experienced that huge market crash for the pandemic and it's recovered on an absolute bull run since. However, what we can expect is that there will also be years where there's a downturn and we lose money across the course of that 12 months. So the average we can assume is around about 8% in the long term, okay? So if we have a mortgage rate that is fixed at a particular rate, we know exactly what our return is going to be by paying down that loan, and that is the exact amount of your interest rate. So the return on my money by paying my interest rate is 2.49%. So for every $1,000 that I contribute to this loan, I'm going to save myself $24.90. You know, it's not a huge amount, but it's not a terrible return either. I'm paying down that liability, so eventually I will not have any cash outflow in order to own that property. Now, when I invest in shares, however, if I'm assuming an 8% return, and some of that is through dividends and some is through capital growth, there are a few really cool things that occur with that. When I have dividend income and I reinvest those dividends buy me more shares, so my shares volume or the amount of shares I own grows. Then the next time I receive a dividend, I'm receiving that from more shares. So this keeps going on forever. So my shares buy me more shares, which buy me more shares, which buy me more shares, and so on. Why this is good is because your compound interest rate is basically that 8% per year, or 4% if we look at just the dividend and not the growth, that 4% dividend growth per year, but this is compounding on itself. So if I had 1,000 shares, then the very next time I receive my dividend income, okay, I'm going to have 1,040 shares. And then the next time I'll be earning that 4% on 1,040 shares. So that will just keep compounding over the long term. This means that the cash flow you can expect to return from your share portfolio is going to exponentially grow over time. And obviously, the more time you can leave this uninterrupted compounding to occur, the better. Over the course of 1 year, you won't notice a huge change. You know, accumulating an extra 40 shares on a holding of 1,000 doesn't seem like a big deal. But over the course of 40 years, you will accumulate a whole lot of money. Now, this is going to be a faster growth rate than what we can potentially receive by holding property and paying down the loan, because the interest rate will always be exactly what the loan is fixed at, or whether it's variable, and the return will only ever be how much that interest rate is on the cash you put into it. Now, in property, we can obviously assume that the value of the property can increase or drop over time. We can earn rental income off these properties, but on our own cash outlay, the return is quite low. One of the powerful things about property ownership, however, is you can use leverage in order to get into the game in the first place. So the return on your 20% deposit, if your house doubles in value, is actually massive, because let's say you had a $500,000 house, okay? You put down 20%, so $100,000, and the property value doubles, okay? So you've put down 100,000, your property is now worth 1 million. If you were to then sell it, you've basically returned yourself, after you pay off that loan, $600,000. Okay, so that's pretty awesome. $100,000 down, $600,000 back with a profit of $500,000. Obviously, we need to make for other accounts with that. So you need to make an exception for the interest you pay, any property management fees, having insurance on the property. But if we just look at the capital appreciation and gain and no other factors right now, that's pretty cool. So obviously in the short term, property can do very well, but we have to be able to find a property with the opportunity for that capital appreciation. And that's not always possible, you know. One poor circumstance in the market can affect it. One poor tenant can ruin your investment if they trash your property. So there's an inherent amount of risk and a very low amount of diversification when you own a single property. Now, through investing in shares, you can own many properties, many businesses. You can own different sectors, and therefore you are more, I guess, risk tolerant and more diversified, negating any single sector or single business or single property risk. Why I personally prefer to invest in my share portfolio instead of paying down my mortgage quicker on my properties is because I really believe in the future cash flows of the businesses that I own. Like I've spoken about in previous videos, I own shares in very large broad market indexes. So I've got United States shares, Australian shares, Asian market shares, European shares. And this is basically allowing me to capture all of the growth of the entire world. So I definitely believe that the two little properties I have are probably not going to return as much as these tech giants and, you know, some of those amazing mining companies that are coming out of the woodworks and all of the resources and financials that exist on the stock exchanges around the world. So whilst having a property is definitely a sort of investment play that can allow you peace of mind and to sleep at night knowing that you do have somewhere to live, especially if, you know, your rental agreement where you're living fails, or, you know, you need somewhere to live all of a sudden, you have that available to you. However, I do believe that the cash flow and the growth potential by investing in shares far outweighs what you can return by buying property. Even if we have those extreme circumstances where our properties can double in value across a 10-year period or something like that, we can actually also assume the same sort of gain from stocks and shares. The only thing is, because we're often purchasing shares in an unleveraged way, you're not going to get the leverage advantage of buying property with a small amount down and then paying off a loan in order to achieve those capital gains. You have to put out the cash flow initially to buy those shares and then hold them for the long term to experience that growth. The other side of that, however, is we're often buying shares unleveraged. Therefore, there is no risk, you know. If you have an outstanding loan and you lose your job, it's very, very stressful, and you want to have that peace of mind and that comfort factor when investing, because otherwise our emotions can manipulate our behaviors. If you find yourself unable to sleep at night because you've done a margin loan against your share portfolio, or you're redrawing from your property mortgage or refinancing just in order to get more money, you know, then that can be extremely stressful, like we experienced last year when, you know, a lot of people's income was very questionable. So I want you guys to really think about what is going to allow you to sleep well at night, what you believe is going to give you the best return in the long term, and do you perceive that you're going to prefer that physical asset by owning a house and having no diversification, or do you feel like you want diversification, holding multiple businesses or property portfolios across the whole world? For myself, my perception of this has changed over time. You know, I used to be of the opinion that before I was 30, I wanted to own 5 houses, but that was when I was a little less educated and very naive. And, you know, upon reflection, I can now say that that would be an extremely stressful way to live, having 5 properties, pretty much at, you know, 85 to 90% leverage just to get this to happen. And, you know, if there was any volatility within your earnings, or you couldn't get a tenant in that property, or, you know, there were damages or any sort of horrible event that occurred, it would be extremely hard to get by knowing you have this much cash to outlay per week in order to cover those loans if you didn't have the appropriate tenants covering it for you. So I think the best method for me to help me sleep at night and to help me get through unscathed through my investment journey is to buy these shares in a diversified and safe dividend growth play and increase my cash flow over the long term. Obviously, owning one or two properties can be really good for cash flow later down the track, but I don't want to get my property portfolio to the point where it is no longer worth my time because it becomes so stressful and I can't actually cover those liabilities in a black swan sort of event where I don't have tenants paying those properties rental income for me. So guys, I hope that gives you some insight. I'll obviously get into a bit more of the numbers in a further video because I want to talk about, how we can make good returns on property and shares individually. Buying individual shares and buying an index fund is very different as well, because if you have a high conviction purchase in just a single company, you can obviously experience a lot of growth, whereas that growth would actually be captured within an ETF that is broad market, but it would also offset the losses of another company within that, etc. So it's very important to find the right investment objective for you and make sure that you are high conviction on that so that you don't stray away from that just at any given moment. You want to stick to your strategy at all times, and you want to make sure that you're always extremely motivated to continue that investment journey. The more funds we get into the market earlier, the better the returns are long term. Alright guys, thanks for watching. Don't forget to like, share and subscribe if you got any value from this video, and I look forward to seeing you in the next video.